Hey everybody, welcome back. Well, we have a lot to go over. We're going to keep this unedited. We're just going to rock and roll right through it all. So we really don't need any words to talk about how we're under the 55 SMA, right? We can all see it. And this is the first time that we are here in some time. We're going to talk about why this is happening. A lot of people are equating it to the war. Yes or no, it's exacerbating the situation, but it's really based upon the risk-free rate and earnings yield. And we're going to discuss this because people are going to be looking for this bounce and then not understanding why it's so methodical. What do I mean by methodical? Let me show you what I mean. So the one thing that people are not going to get is how come you just stair step down? In other words, you hit a level and then that level from there, it starts to go, right? And there are some reasons for that. But let's just take a look at this for a moment before we get into all of it. But you see the stair stepping? And then all of a sudden when it breaks and then you just kind of stair step down, watch this on a 1 minute chart. And then you can just see start happening right around very key levels around 1 o'clock today. You had some data around 11:30. We all know what that data was and we're going to go through that as well. And you'll note from that data at 11:30 on, you never really got over. If you equate that data and you take a look at TNX, let's just drop this to a line real quick because we are going to get into this. And we just take a look at that 11, drops down to that 11:30. And you'll notice from here, what happened at 11:30, you never were able to really get back under that, right, on the 10-year. And we're going to explain why that was and what it means for us and why it's so important. But let's just start jumping right into it. So if we take a look at the ES, the most important thing to take away from this is that you cracked. I mean, we need to call it what it is. You cracked. I'm not adding a tremendous amount of value there, but I think we'd be remiss and not just getting to it. This is a 12, this is a 22. You should use what you're comfortable with. This is the 55. Again, this is going to be packed. You might want to watch parts of this again. But once you broke, that's it. You closed at the low of the day. There's no more discussion, right? Like when something technical like this happens, that's it. So when I say that I am top down as a trader, what I mean by that, let me just click this over. Here's the index, here's the sector, here's the stock. If all three are pointing down, or if the index is pointing down and the sector's pointing down, and I am going long, right? Or in this case, short or long stock, then I'm fighting the trend. Let me click that off right here before this starts getting goofy. But where I'm going with this is that's how you have to look at it. So if the index is pointing down, if the sector is pointing down, and you're going short stock, you are with the trend, okay? If the index is pointing down and the sector is pointing down and you're going long stock, you are fighting the trend, okay? The trend is your friend. So when you see this, yes, you can still go long, but you're fighting the trend. Right? Case in point, we had an NVDA trade on and we did not have a trend yet, meaning the trend that we had was trendless. And if you take a look at the Qs, everyone will now have a reason why this happened. I get it, right? But I'm making a joke because I'm sure I'm going to get comments on it. But like, yeah, okay, you could say the 12 to 22 is rolling, but you don't know it's going to break. It's been doing this kind of nonsense for a long time, right? Okay, but it broke. You got your answer today. You have a Marbuzu black right here, which is a pretty significant bar to have on the NASDAQ. And now you have a control bar on top of it. And what we would note is that this control bar had to make a decision, and it did. And that's the decision. So the question is, how long is this going to go on for and what's going to affect it? We're going to get to that. But you need to understand that when you're watching the videos and the content that I put out, I am a top-down trader. I am not a bottom-up trader. Okay, there is very different. There are people that will go out there and they'll find names and they'll like those names and they'll just buy them because of X and Y. For example, I really liked a couple names that I saw out there recently that looked great. That they actually looked like they were going to, hold their ground and move. I'll find one, for example, that I was really looking at that I liked. I liked Cost a lot. I liked how it was breaking out, consolidating, but once it reversed today, I can't go near that. A matter of fact, that's just like an outright short to me now. The way that you reversed over and closed here, that's technically a short to me at this point, right? So even though I was looking at it as a long, it reversed. And when I see that kind of stuff, I have to pay attention to it. So what does this mean? It means that I have to start looking at some of the defensive names and see how they're doing, and they're not doing so well. So the problem for me in this kind of environment is when we start to see this and we start to see these changes, and we start to see the selling is we're doing this into earnings. We're doing this into the corporate buybacks are starting. We need to start saying, okay, how bad can this get, right? So now we've made a decision. So now you have to go, how bad can this get? And stay with me. I'm going to show you some other stuff, but you have to start going, well, I need to look at technical indicators. And some of the technical indicators that I would use are going to be things like rate of change. I have something here I jokingly just call the 4 horsemen. And what they are is they're 4 very specific indicators that I use. And I just put them all in a chart, but I'll just drop it right here and start with it. So just looking right now, I don't really have a lot of problems that I'm seeing right there with number 1. And then if I just start going through them, like this is MACD. MACD is definitely giving me a problem, right? So I'd start going, okay, well, MACD looks like we're going to cross the zero line for the first time since November. So I actually quantify this just by going through them and looking at them very quickly and saying, okay, well, then I'd go to the next one and go, okay, well, I really don't like the way that that's shaping up right now. Let me just show you this so that you can see them. So this is rate of change. That's MACD. This is RSI, and I have a slow stochastic down here that I use, but not that often. But once this rate of change, for example, gets under that and it's negative, it's game over, right? Like you can't have a negative rate of change and expect the market to go higher unless you have a trajectory that's pointing up. Please listen to that again. It's just not, it's not feasible. Right. And I also have something else I really want to go over because it's really bothering me. So I'm going to address it. But what you have to look here is like I have RSI. Very rarely when I'm using RSI to trade, do I look at the moving average. I use different levels than most people on these. But when I look at stuff like that, okay, I'm breaking and I can't even get anywhere near the trend line. And my trend line's different. And so are the metrics there. You can look on the left and you can see them, but there's more to it. But when I start to see that kind of stuff, I have to pay attention to it, right? And so, okay, we made a decision. I have to honor that decision. I can't really go against the grain. So if I go here, take a look at this, drop this down here and go 1222, and I see that, can I get something that changes my mind? Yeah, and I hope that I get it. What could I get? I could get good ASML data that changes this. I could get good Taiwan semi data. We could have some world peace. I think that'd be great. But until we start to get that, I have to realize that ASML data and that Taiwan semi data is going to go against the grain of the stocks right now. Well, how do I know that? I know that these numbers are going to come out. I know they're supposed to be good. I don't know that they're not going to sell the same way that they sold JP Morgan. So JP Morgan was probably one of my better, well, not really, but it was a good short today. I did well, but I killed it in a coin short. If you take a look at this, right, over during the day, and this is what I was trying to get everybody to understand in the pre-market, and I think we got it, but you popped over and then you were having failures. So this is really where you have to watch. And this is the stuff you have to pay attention to. You're getting these failures. You're getting we're going to lure you in. Come on in. The water's fine. You're getting a lot of those, right? So what you want to do is demarcation lines. Please listen to this. It's really important. So you want demarcation lines, right? If you are below like a 55 SMA and you're not using something to day trade, like just something as simple as a VWAP, you might as well just write a check to St. Jude's. You're going to have a lot of problems here. Okay, a lot. You're fighting the tape. I want to explain why you're fighting the tape and why are you seeing weakness. We all know the sentiment's changed, right? But I just want you to understand this one concept before we go any further. I'm going to start here. And if you've watched my videos before, you're familiar with this concept. And this is a very important concept to get. So please just give me 2 minutes here, guys. Okay. You want to note this number, 4.03. Why? That's earnings yield. That's the S&P 500 earnings yield. All right. Let's show you how they're calculating this and how it's been moving. Now, I just want to show the earnings yield on the S&P for the past year. 4.26, 407, 430, 403. This is what earnings yield is, all right? Because now that you've seen it, everybody knows that one of the things that's really important to me is that people understand what the heck you're actually looking at. And this will explain why you're having the issues right now and why yield is important and why you need to watch the 10-year and why you need to watch the auctions. The S&P earnings yield reflects the sum of the underlying S&P companies' earnings for the previous year, divided by the S&P 500 index level at the end of the year. The S&P 500 is a basket of 500 stocks, market cap weighted, most widely followed index, blah, blah, blah. As a broad market index earning yield, one can compare to the 10-year treasury to determine valuation of the U.S. stock market relative to the bond market, as well as price forecasting. After the financial crisis, the yield valued hovered around 5% on average for 10 years. What are you getting right now? You're getting 4%. So you are getting 20% less in yield in earnings than you normally get. That is not even the issue. That is not even the real issue. Now you can see where Q22 is, Q2 23. So Q2 23, we know when that is, and you can see from that point on that at a minimum you were at 420 in that area, okay? Now we all know that if you buy a treasury, that you're going to get a risk-free rate. We all know that, right? So if we go here and we look at from when did the Fed say that they were going to stop raising rates? Right here. And that's when the market exploded, okay? And so you had 460 up here, but they thought that we were going to go into cuts. This is why cuts are so important. So here you are November 2nd, right? So we're going to drill this all down here so you can see this. And when you got to this level, in January, all right, when you're down here, you're getting 380 yield on the 10-year, and you're getting a 4% earnings yield on the S&P. So you're actually getting more on the S&P than you're getting on a 10-year, right? Makes sense to everybody? See how they're buying bonds and how that buying of bonds drove the S&P higher? Then even as this goes up, it doesn't matter. Why? Because earnings were going up at the same time. But now you've hit what? A level where they're not going to cut rates as soon as we thought. I think they're out to July or September at this point. And now you have the index, or the 10-year, I'm sorry, right back to where we were, roughly, right back to where we were when we started. So now you're getting 460 or 60 basis points more than you're getting in the S&P. That's why this is becoming methodical in its selling. That's why this selling is becoming methodical. Because, we're waiting for this to turn and not understanding that it's dropping based upon a macro valuation, right? I'm not going to bring out the stool tonight because there's too much to go over, but you remember it, right? The macro, the fundamental, and the technical, okay? They're the things that we always look at. I said, I'm not going to bring it out. Now I just drew it. But you get where I'm going with this, right? We always want to pay attention to this, okay? This macro leg. So institutions are the ones that are going to go out there and reduce exposure, reduce net exposure to the market. That doesn't mean that they're not going to buy tech with their gross exposure, but their net exposure to the market's going to change. There's a big difference between gross exposure to the market and net exposure. All right, we can get into that in a different video. But as you're seeing here, what is this telling you? This is telling you that we have cracked a level, and this is how I look at these levels. So the 12 for me is where do you want to swing trade or do you not want to swing trade? Okay. When you look at the 22, you're looking at that saying, who's in charge, bulls or bears? Okay, if I'm under, the bears are in charge. If I'm over, the bulls are in charge, right? This is why your trades will work better in certain areas than others. 55 is institutional support. If you crack that, you don't have institutional support. Can you rally back over that? Sure. Give me a reason. World peace, the bond market's going to come down, or earnings are going to be through the roof. And I think that we have earnings on deck. Now, you have ASML this week, which will be absolutely huge for semis. But what we're seeing right now is they're selling into this. Just like they sold JP Morgan on what I thought was a fairly good report, but they picked one thing out and said, this is what we're worried about. Goldman, I thought was a good report, but you basically closed at the low of the day and you sold down all day. And if you take a look at this, if we look at Goldman, one of the keys that we're going to have to look at is just the fact that you couldn't get past that 5-minute bar. And once you cracked, that was it. It was pretty much the easiest short out there once it was done. You kept waiting for the bounce, right? You had your little doji in here and you kept waiting for the over and then the bounce back up. Never happened. So you just kind of traded down today. Some of these names were fairly easy to short. Others were not. And what I say to people all the time is, when in doubt, just stay out of the way. But there are ways when you're in an indecisive market to trade. And it doesn't mean that you can't go long tack. You just have to understand that whether you're in a consolidation phase or a down phase, how you have to trade it. And you have to look at this the old way. So and what does that mean? If you looked at the market and you remember, and some people have traded during this period of time, others haven't. But if you traded during this period of time in here, you will note that when you traded this, your breakouts were failing, right? Your breakouts were failing in here. All right, so why? They're failing because what they're doing is they're either luring you in or they're using that for liquidity. They're using retail for liquidity, right? We showed that the other day. We started going through smart money, dumb money, and walking through that. So, all right, so let's say they're using retail for liquidity in some of these names. What does that mean? That means they're looking at charts, okay? And they're looking at when these things are breaking out and they're triggering to lure people in. I don't think anything could be clearer. Anything could have been clearer that they were doing that than Apple 2 days ago, where they popped Apple off a support line 2 days later and you ran right into a 55 and it hit like a ton of bricks. I don't think there was anything that could have been more glaring. Well, someone used to say absolutely glaring until they made fun of them. Right in here, I don't think you could see anything more absolutely glaring than that, right? Okay, so we understand what they're doing. So when I say this, what you want to do is there's services that you can do and look at what I'm about to talk about. So this was something that we shorted, and I'm not going to cover it today because there's another name that I want to cover so that you can utilize what I'm going to show and show you how that you would do this. But I want you to understand this. Okay, so for me, looking at coin, when the underlying asset is going down, which it was, and this is trading up, that is a negative divergence. After you've been here for a period of time, it was very clear that this was setting up to drop, right? So what they do is they pop you over here. okay? And they get everybody giddy. Look, we're going up. We're definitely going up. And then the underlying asset's not following suit. Now, if you look at the underlying asset, it trades at different times, obviously. But when you start looking here and you see this and we're unable to break out and they're popping names over like that, they're setting you up, right? It's very different than when the underlying asset is moving and that the name is running ahead of the underlying asset, right? So there's different ways to look at this. So what I want you to get from that is once we saw that, all you needed was your setup. And then you got your setup on Friday. And this allowed us to put a short on. And we did quite well with that short today. And we did quite well with the puts. I still have some of the puts. We did the 240s. I think we paid 7 for them. And we've done quite well with the trade. These kinds of trades where you're shorting into the breakouts, they're going to work. And so is the other side of this. So let me explain. So you would look at this chart and think that this looks the same exact as coin. It's very different for a couple of reasons. Number one, earnings, driver, institutional support. But most importantly, when you have an event that's coming out like ASML, Taiwan Semi, and they're supposed to be really good, people are going to try to trade these ahead of those, right? They're going to try to get ahead of it. So with NVIDIA, for me, we had a nice trade the day before, but then I bought some calls in here. Let me show you what I did, because it didn't work, and I want you to get this. Because this is the kind of environment you're in, okay? And this is where you take the risk. And if it doesn't work, it doesn't work, then you know what you have, right? See, when you get stopped out of something, people always look at it and say, oh, I lost. No, you gained information. You know what not to do, right? That doesn't mean you hold on to it. You know what not to do. So we had some calls in here, and then we walked into this nightmare the next morning, right? It just very simply, trade didn't work. You could have held the calls or got out of the way. Either way, it just didn't work, and that's going to happen. And then you can see this coming straight across. But what we did, and I walked through this on Saturday a little bit, was down here. I'll pull this up for a second. Hold on and show you. So you can see this on the 12th. I want to pull this up so that you can see it. So I want to show the timestamp on it, not the trade itself, but so that you can see what we put out there. So these are the calls that we were saying to buy at this time. We were using a 50% stock. We could also use the swing. Swing came later once it triggered. And really what we're doing is we're buying right into this, right? And then the stock pops up and it starts to trade. And these are the 240 puts over the weekend. If you want, I can walk through that trade tomorrow and how to scale out of options in this kind of environment. This is a very different kind of environment, especially today, because you're developing a bearish trend. Okay, you are developing a bearish trend. Whether we want it or not, you crack the 55 and they're selling bonds and the dollar's going higher, right? We all remember that lesson from 6 months ago. Well, if you haven't been watching, dollar rises, yields go higher, equities drop. It's really that simple. We can cover it tomorrow, but I want to cover this so that you know how to do this. So what you're doing into these swings, so you see today, into these swings, okay, we're trimming. NVIDIA swing up, trimming on the open. So I'm stating off the rip, I'm getting out. 944, we're trimming. Up again, we're trimming. Now, the rest is break even on the trade from 335, right? NVIDIA calls a 50%, we're trimming. Why are we doing this? So what we understand is we understand that we're top down. We understand the environment. If this was going to rip, it would have ripped in the morning. Okay, if they wanted to play the earnings calls, they would have played the earnings calls. And how do I know that they would have played that with Taiwan Semi and the ASML? Because you had good economic data. Now, you had good economic data that actually showed that you were slowing in certain areas. And that economic data, when it came out here's retail sales, here's Empire State Manufacturing. You were looking for -9, you came in at -14. They want manufacturing to go down. If manufacturing drops and gets under that PMI, remember manufacturing PMI of 50? Okay, remember we went over this about a week ago. You can see if you're new here, all these videos are linked together. If this is of interest to you, subscribe to the channel, click all notifications. I don't have time to go through all this data and then go back and just pull all the other data out. It would take too long. So if you remember that we talked about manufacturing over 50 is expansion. Well, that PMI manufacturing data is made up from all these states, right? All right, so here we are, and we can see that that is weaker than expected. And what happened to the market? It actually went up. Remember, we were on the pre-market live call today. Retail sales, where that came in month over month, that was a little better than X autos, and you can see how that's going. All right, so what does all this mean? Business inventories were up. What does all this mean? Well, this means that you had a reason to think that they could cut rates sooner. What happened at 11:30? You had a 522 on the previous 3-month auction. The 6-month auction, you had a 512, you have a 515. So if we go and take a look at that, and then you go and take a look at how Taiwan Semi and all these names played out after that. It doesn't take a rocket scientist to start looking at some of this data and go, oh, 1030 came down 1130, tried to rally into that number, and then what happened? We fell apart. Okay, so where did we fall apart? We start looking at that open. You fell apart when you got back to the open. Please listen to this next statement. If you're going to trade in this kind of environment and you're not marking the previous day open, high, low, and close, you're at a huge disadvantage. A lot of people, what happens in these kinds of markets, corrections, when they get back to break even, they're like, oh, thank God, I'm at break even. Where else did you notice that? The people that were in from Friday, right? All the people that got in on Friday, what'd they do? Oh, thank God, I'm break even. I'm never doing that again, right? And what do? They get out. And so that's what you're seeing. And you're seeing these highs marked. And you can actually see the open right here was marked again, but you can kind of get that from right there. So what we're doing on this trade, we're watching, right? So I have a bunch of it on. You watch the gap fill, comes down. So I'm trimming into this. You watch the gap fill, which is right here, is actually a little bit lower. And then we just start clearing levels. And as we're clearing levels, we're scaling out into it, right? So another big level was that 92. We went through that pre-market. As we're hitting them, I'm not waiting to see if they're going to break through. I'm selling into them. I'm getting positive slippage. Hits again. You can go correlate this with the timestamps I just showed you. It's really important that you see all this stuff. Flips, undercut, and then you have the lower low, and that was it. And when you start to see these lower lows, they were all connected. And I'll show you what I mean by that. So here you come across and you see the AMD, right? And here's the 15th. Now, once you saw this, it was pretty much on, and I shorted this today. I did okay with it. Quite frankly, I didn't do as well as I thought I was going to do. But once I broke this, so there's your open, watch, there's your opening price. Tries to get there, can't. Tries to get there again, can't. So I shorted when it broke here, and I probably could have shorted it earlier, but I was concerned about the 10 o'clock level. So then I watched, and then from there, 1130 hit, never got over it, and then you have the war escalation. Is the war escalation an issue? Yeah. It's definitely an issue. If we get world peace overnight, yeah, we'll probably have a rally. Do I think that gold's going to go higher? Yeah, there's a chance now. I didn't think it would. I actually think that this is a topping pattern. If things really escalate, yeah, they're going to buy gold. It's a really tough bar on gold and silver to get through. The point of me getting this is that you understand the environment that you're in right now, so you must pull money out of the market. Okay, this is what I always learn from people, and I really want to stress this with people that are watching stuff on social media and people that are watching like Twitter and saying, oh, you're supposed to buy this one right now and you buy this one right now. You can call yourself a swing trader, you can call yourself a day trader, you can call yourself a blueberry for all I care. Your job's to make money, period. End of story, right? It's not to give yourself a new cool nickname, okay? It's to actually trade and make money. Looking at this market and trying to say that I'm going to swing trade, you might as well write a check. Like there's literally no chance that you're going to look at this over the past 3 weeks and say, oh, I'm going to swing trade that. I'm going to swing trade coin. Okay, how's that going to go, right? Or I'm going to swing trade MicroStrategies here, or I'm going to buy Hood. Like none of this, and this is the point that you have to look at. And then I want to get to some other data. When you look at XLF rolling, okay, and XLE rolling, okay, show me an environment where the S&P went up. When you lose energy and you lose the financials, okay. Now tech. We lost tech today. So there is not one time that someone's going to be able to point to me that another sector besides energy or financials or tech led the S&P. If you lose those three, which you have, technically speaking with the 55, you're fighting the tape. You want to swing trade in that environment, good luck. Now, I did promise that we would go through these because of your comments on the watch lists that I use and take a look at some of these levels. And I do think it's really important to look at this. So someone's going to say to me, oh, well, you're calling for this huge crash. I'm not. If you don't understand what you're supposed to look for in order to see if this is going to turn, I strongly suggest you watch parts of these videos again because it's actually in there. So when we see things like this, okay, and I was asked to go through these today. I was asked in the pre-market too, and I wasn't able to. Sorry about that. Let's click off of that and get to a bear chart. Would have been happier if I actually got to the bear chart. Bear means plain for those that don't understand it. I can start saying plain if people are more comfortable. I don't know why the word bear makes people so uncomfortable. There's so many other things that should make you uncomfortable than that. So what we have here is we have S&P stocks above the 5-day moving average. You're at a 2. That's really, really, really low. What does that mean? Usually you see some kind of bounce if you see that. So is there a chance of that? Yeah, there's a chance. So let's go back and we'll use year to date and realize that you've never been this low year to date. Now that's good and bad, right? Because you can't have 98% of all stocks below the 5-day moving average. Some sector will eventually bottom out and get there, right? So what you're looking to do with this is if you go take a look at March 28th, that was the peak when you had 90. If you go look at March 28th and you go look at December 13th, right, and you go and take a look at things like that, you'll probably note that you probably are pretty close to like a high or somewhere there. Like here's your high, March 28th, and the other I think was December 13th, right? So we'll go find December 13th real quick. Okay, so you rally up and then you go sideways and you hung in there actually, right? Because the others would have picked up behind it, like the 20-day, right? So this is S5TW and you're at a 9. Okay, when was the last time you were at a 9? Okay, well, that was November 1st. All right, so what you're going to see here, again, is if I mark off the 20-day and go, okay, well, this is where I'm at, and did we bounce around here October 4th, November 1st? Yeah, we did. I'm sure that if we overlay here and we put the SPY here as well with it, and we just looked at that for a second, and we match those dates, that, yeah, you're probably going to see something pretty there with it that's going to correlate to that, right? So if I just go here, for example, and click on this and go, okay, well, here's March, but if I wanted to look at October, well, let's go to that November and mark it off, you're going to see that level really clear right in there, right? And see that there's your bottom. So if you start to mark these off and say, okay, well, that's where we are again, could we do the same thing? Yes. What's the catalyst? Or you go here and go, yep, we did for a little bit, and then we bounce back down. What you want to do is use these short-term indicators for short-term moves. See it? See how you bounced? You bounced for a couple days. Could you bounce again? Yeah, you could. How do you know that? The 5 is below where it should be. So if we go back and take a look at the 5, and you're overlaying that 5 with this, and you start saying, well, did you bounce there? You bounced for like a day, maybe a day or two, right? So can you bounce based upon this? Yes. Here's where the rub really comes in on the larger ones, like the 50-day, okay? Because the 50-day really doesn't bounce. I'm going to click this off for a second. We'll put it right back that you get this. Again, these are all free. This is all in TradingView, and you can look at them. But here's S5FI. Okay, where does this actually bottom? Okay, this is where you bottom. So I've said this a bunch of times. Once you get up to like a 90 or a 91, in order for this to actually ever really bottom, you wind up having to get into this little area. And every single 90 area that you ever have for this to ever really bottom, and it doesn't happen that often, guys. You're not up here very often. I want to be really clear about that. So if we just drop a weight going across and we get that 90 level right up here. Okay, how many times have you really been here since 20, 21, 2, 3, 4, 5 times since 20, right? 6 times since 19. You're not up here a lot, guys. So once you're up here, you're up here. Okay, and what you're seeing is we're slicing through those levels pretty fast. You need to get to a 9 or 10 before this is over, right? That's usually what you need. Like if you look good over a 90 and you go through this chart, it is very rare that you don't do that until you get back over. Matter of fact, I think it's only once that it happened this time, and then it happened here, and this was when they had 1.7 trillion injected in the stock market. But every other time you can see that when you get to that level, you have to come here before you wash out, right? It's just an equilibrium. It's just like a pendulum, okay? Take a look at this, and I know this video is long tonight, guys, but there's a lot. And then you go, okay, well, what else do we need to look at? Well, the 200-day. All right, so where are we on the 200-day? You're just starting. You're literally just starting to break. The lows on the 200, when you really look at where they come in, you could make an argument that you could stop at like 23. The real big washes are down here at like 11. And I'm not saying we're getting there. I'm not saying that you can't pull back down and rally, but what is your driving force, right? So we've lost the macro as the driver, okay? So we only can have one other driver right now. Technicals are not the driver, okay? So when we look at the stool, that's where I'm going with this. We only have one leg left, which is fundamentals, which is earnings. So we need earnings to be really good this quarter.